Today we're tackling financial statements and accounting fundamentals for the Series 65 exam. The exam expects you to understand how to read and interpret the three core financial statements: the income statement, the balance sheet, and the statement of cash flows. You won't be a CPA, but you need to know what these documents tell an advisor about a company's health. The income statement, also known as the profit and loss or P&L, shows a company's financial performance over a period of time, like a quarter or a year. It starts with revenue, subtracts the cost of goods sold to get gross profit, then subtracts operating expenses to find operating income. After other expenses like interest and taxes, you arrive at the bottom line, net income. A common exam trap is to confuse revenue with profit. A company can have high revenues but be unprofitable if its expenses are higher. The exam will test your ability to identify major line items and what they represent. For instance, you might see a question asking where to find a company's interest expense, and the answer is the income statement. Next is the balance sheet, which is a snapshot of a company's financial position at a single point in time. It's built on the fundamental accounting equation: assets equal liabilities plus shareholders' equity. Assets are what a company owns, like cash, inventory, and equipment. Liabilities are what it owes, such as accounts payable and long-term debt. Shareholders' equity is the owner's stake. The exam loves to test the distinction between current and long-term assets and liabilities. Current means within 1 year. So, accounts receivable is a current asset, while a factory is a long-term or fixed asset. A mortgage, on the other hand, is a long-term liability. The third statement is the cash flow statement, which tracks the movement of cash from operating, investing, and financing activities. The exam generally doesn't get into the nitty-gritty details of this statement, but you should know its purpose. A key concept tested is that a company can have positive net income on its income statement, but negative cash flow. This often happens due to non-cash expenses like depreciation, which is subtracted on the income statement but doesn't actually use cash. Regarding accounting fundamentals, the Series 65 expects you to know the difference between cash and accrual accounting. Under generally accepted accounting principles, or GAAP, public companies must use accrual accounting. This means revenue is recognized when it's earned, not necessarily when the cash is received. This is a crucial concept. For example, if a company provides a service in December but doesn't get paid until January, under accrual accounting, that revenue is recorded in December. This prevents companies from manipulating their financial results by timing cash receipts. Here's a mnemonic to remember the core of each statement. Think of your personal finances. Your income statement is like your monthly budget, showing what you earned versus what you spent. Your balance sheet is your net worth statement at this very moment, listing what you own and what you owe. And your cash flow statement is like looking at your bank account to see where money actually came from and where it went. For the exam, focus on the big picture and the relationships between the statements. Don't get lost in complex calculations. Understand what each statement reveals about a company's financial story. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.